Welcome to my channel, Wealth Ledger.
If you've ever thought about investing but felt overwhelmed by stock picking, complicated strategies, or endless financial jargon, you're not alone. Fortunately, there's a solution that makes investing simple, low risk, and effective: index funds. In this video, we'll break down everything you need to know about index funds in 2025, from what they are, how they work, why they're ideal for beginners, to how you can start investing today. By the end, you'll understand why so many investors swear by index funds as the easiest way to grow wealth over time. What are index funds? Let's start with the basics. An index fund is a type of mutual fund or exchange-traded fund, ETF, that aims to track the performance of a specific market index. A market index is basically a collection of stocks representing a particular segment of the market. For example, the S&P 500 tracks the 500 largest companies in the US, while the Nasdaq 100 focuses on tech-heavy companies. When you invest in an index fund, you're essentially buying a tiny piece of every company in that index. That means your investment mirrors the performance of the entire market, rather than betting on individual stocks. This approach provides built-in diversification, reduces risk, and simplifies investing for beginners. Why index funds are ideal for beginners? Many new investors struggle with picking individual stocks or timing the market. Index funds remove this guesswork. Here's why they're beginner-friendly. Diversification: by holding hundreds of stocks in one fund, your risk is spread out. If one company performs poorly, others in the index may offset the loss. Low fees: index funds are passively managed, meaning they simply track the market rather than trying to beat it. This keeps management fees extremely low compared to actively managed funds. Consistent returns: while markets fluctuate in the short term, index funds historically deliver solid long-term returns. Simplicity: no need to research individual companies, read balance sheets, or monitor trends constantly. You invest, hold, and watch your money grow over time. For beginners, this combination of simplicity, diversification, and low cost makes index funds one of the smartest ways to start investing. How index funds work. So, how exactly do index funds work? It's simple. First, the fund provider creates a portfolio designed to match a particular index. For example, an S&P 500 index fund holds shares in all 500 companies in the index, weighted by their market capitalization. The value of your investment rises and falls along with the index. If the S&P 500 goes up 10% in a year, your index fund's value generally increases by about the same percentage. Dividends from the companies in the index are usually reinvested automatically, helping your investment grow over time through compounding. The key takeaway: when you invest in an index fund, you're not trying to beat the market, you're matching it, which historically has been a very effective long-term strategy. Types of index funds: not all index funds are the same. Here are the most common types. Broad market funds: these track the entire stock market, such as the total US stock market or global stock market. They provide maximum diversification. Sector or industry funds: these focus on specific sectors like technology, healthcare, or energy. They carry more risk but may offer higher growth potential. Bond index funds: these track a collection of bonds rather than stocks. They're generally less volatile and provide steady income. International funds: these track foreign markets, helping diversify beyond your home country. For beginners, broad market index funds like the S&P 500 ETF or total stock market fund are often the easiest and safest choice. Benefits of investing in index funds: investing in index funds comes with several key advantages. Low fees: passive management means lower expense ratios, leaving more of your money invested. Diversification: exposure to hundreds or thousands of companies in one purchase reduces risk. Transparency: you always know what you're invested in because the fund mirrors a public index. Tax efficiency: index funds generally have lower turnover than actively managed funds, which can reduce capital gains taxes. Long-term growth. Historically, stock market index funds have delivered annual returns of around 7 to 10%, outpacing savings accounts and most other investments. These benefits make index funds especially attractive for investors who want consistent, long-term wealth building without constant market monitoring. How to get started with index funds. Now that you know why they're great, let's talk about how to actually start investing. Set your goals. Are you saving for retirement, a down payment, or long-term wealth? Knowing your goal determines how much risk you can take. Open an investment account. You'll need a brokerage or retirement account. Platforms like Vanguard, Fidelity, Charles Schwab, or even apps like Robinhood and Webull make it simple for beginners. Choose your fund. Start with a broad index fund like an S&P 500 ETF or total stock market fund. These provide instant diversification. Decide on your investment amount. You don't need thousands to start. Many platforms allow you to invest just $50 or $100. Automate your investments. Set up recurring monthly contributions. This strategy, called dollar cost averaging, reduces risk and helps grow your investment steadily. Hold for the long term. Resist the urge to sell during market dips. Index funds are designed for long-term growth, and history shows patience pays off. Common mistakes to avoid. Even with a simple strategy like index funds, beginners sometimes make mistakes. Avoid these pitfalls. Trying to time the market. Don't buy or sell based on short-term trends. Time in the market matters more than timing the market. Ignoring fees. Even small expense ratios can eat into your returns over decades. Stick with low-cost funds. Overconcentration. While it's tempting to chase hot sectors or trends, sticking with broad market funds reduces risk. Not reinvesting dividends. Reinvesting helps your money grow exponentially through compounding. Staying disciplined and consistent is far more important than trying to be perfect with every investment decision. Index funds versus individual stocks. Many beginners wonder whether they should buy individual stocks instead. Here's a simple comparison. Risk. Individual stocks are riskier. A single company can go bankrupt, while an index fund spreads risk across hundreds of companies. Time and effort. Picking stocks requires research, analysis, and ongoing monitoring. Index funds are hands-off. Returns. While some stocks can outperform the market, most do not. Historically, index funds often beat the average stock picker over the long term. For most beginners, index funds offer the best balance of simplicity, safety, and growth potential. How much money can you make? Let's talk numbers. Historical average returns for the S&P 500 and similar broad market indexes are about 7 to 10% per year, after adjusting for inflation. Investing $100 per month over 20 years could grow to roughly $50,000. Investing $500 per month could grow to over $300,000 in 20 years. The exact numbers depend on market performance, contributions, and time, but the key is consistency and patience. Even small, regular investments can grow into substantial wealth over decades. The role of compounding. Compounding is your secret weapon. When you reinvest dividends and let your returns generate more returns, your wealth grows exponentially over time. Starting early, even with small amounts, maximizes the power of compounding. Think of it like planting a tree. You water it regularly, give it sunlight, and over time it grows into a strong, fruitful tree. Index funds allow your money to grow in the same way. Tips for 2025 and beyond. Here are some extra tips to succeed with index funds in today's market. Keep it simple, stick with broad market funds for long-term growth. Avoid emotional decisions. Don't panic during market dips. Downturns are temporary. Rebalance occasionally. If your portfolio shifts too much from your goals, adjust to stay aligned with your risk tolerance. Educate yourself. Follow credible finance sources to stay informed, but don't get distracted by hype or speculation. Start early, time is your biggest advantage. The sooner you start, the more you benefit from compounding.
Thanks for watching video. Please share with friends. Subscribe, bell icon, and share.